Welcome to This Explainer. Today, we're unpacking a truly staggering earnings report. We're looking at UnitedHealth Group's second quarter of 2026, and they just posted an eye-watering $112 billion in consolidated revenues for a single quarter. But we aren't just going to look at the cold, hard math today. We're going to explore the intense contrast between those massive financials and their actual human impact. We'll look at exactly how this unprecedented scale of revenue is being utilized and what this corporate momentum actually means for the future of the American healthcare system. So to really ground our analysis, let's start with a key quote from CEO Stephen Hemsley. He said, "Our results and outlook reflect the continuing progress in our work to simplify how we operate, improve both affordability and the healthcare experience for patients and care providers." Now, there's an inherent tension here that we really need to scrutinize. I mean, it's pretty rare for a corporation generating over $100 billion in one quarter to immediately pivot their messaging to a social mission of affordability. So are these financial results simply a victory of corporate scale, or are they actually a byproduct of a broader mission to modernize a highly complex health system? That's what we're going to figure out together. To navigate all of this, here's our roadmap for today. First, Q2 2026 financial highlights. Second, a segment dive into United Healthcare. Third, a segment dive into Optum. Fourth, systemic healthcare reforms. And finally, the full year 2026 outlook. All right, let's jump right into Section 1, Q2 2026 financial highlights. In just the second quarter of 2026 alone, UnitedHealth Group brought in a massive $112 billion in consolidated revenues. To truly put that into perspective, that means they're generating over $1 billion a day. Just take a second and let that scale sink in. Over $1 billion in revenue every single day. This represents incredibly steady top-line growth compared to the same quarter last year, and it really reflects the deep structural reach this enterprise has across basically every facet of the healthcare landscape. And from that enormous revenue pool, they generated an impressive $8 billion in earnings from operations, giving them a net margin of 4.9%. But you know what's perhaps even more striking? Their cash flows from operations hit $11.1 billion. They actually brought in nearly double their net income in pure cash. So they aren't just looking profitable on a balance sheet, they've essentially built a massive war chest of actual cash on hand. This gives them a tremendous strategic advantage to maneuver, invest, or just acquire at will. Now you really have to notice the contrasting movement in their underlying ratios here. Take a look at the medical care ratio. To break that down simply, this is basically the percentage of premium dollars that are actually spent on medical care. It dropped significantly, going from 89.4% down to 86.7% year over year. The source attributes this drop to strict pricing discipline, changes in benefit design, and just better medical cost management overall. Meanwhile, the operating cost ratio slightly rose to 12.7%. And the reason for this divergence is pretty interesting. They're actively pumping money back into targeted investments. Specifically, we're talking about infrastructure, artificial intelligence, care delivery enhancements, and community support. Moving right along to Section 2, Segment Dive, United Healthcare. On the traditional health benefits side, United Healthcare served over 48.5 million people this quarter. They brought in $86 billion in revenue and achieved a very solid 4.6% operating margin. Now, you might be wondering, how do you maintain those kinds of strong margins when you lose nearly 1 million seniors in Medicare Advantage and you voluntarily exit a state health plan like they did in Louisiana? Well, the answer is strict, disciplined cost management. Even while navigating massive membership attrition and ongoing Medicaid eligibility checks, they were able to pull the exact right operational levers to drive a highly profitable quarter. Next up, Section 3, Segment Dive, Optum. So Optum is the technology, data, and care delivery side of the enterprise, and man, it is operating at an incredible scale. They're supporting more than 120 million consumers and generating $65.7 billion in quarterly revenue. Crucially, they expanded their operating margins by 1.6% year over year. This success is really distributed across its three main branches. You've got Optum Health, which is leaning heavily into value-based care. Then there's Optum Insight, bringing AI-enabled coding and digital tools to the broader market. And finally, Optum Rx, which processed 387 million adjusted scripts this quarter. Seriously, think about that. 387 million prescriptions managed in a single 3-month window. It's wild. This breakdown brilliantly illustrates the sheer weight of these two complementary engines working side by side. You have the massive, steady, premium revenue base of United Healthcare on one side, and it's perfectly counterbalanced by the high-growth, high-tech, service-oriented revenue of Optum on the other. It's a dual-engine model that allows them to touch, influence, and yes, profit from almost every single part of the modern healthcare system. Which brings us to Section 4,
systemic healthcare reforms. Here we can see a really powerful juxtaposition between their macro billions in revenue and these highly localized human impacts. They've committed a full $1 billion to the UnitedHealth Foundation, specifically to target rural health, maternal and children's health, and behavioral health. Over on the provider side, they're stepping in to rescue 1,500 rural hospitals by cutting reimbursement timelines in half and accelerating payments. And for the patients, they're expanding nationwide coverage for doula care, making it eligible for over 7 million members by early 2027. So we're talking about deep structural interventions into vulnerable communities.
Now, in what is arguably one of the most surprising moves you will ever see from a publicly traded, for-profit giant, UnitedHealth Group announced they're voluntarily eliminating their profits from individual Affordable Care Act or ACA plans for the year 2026. They are going to rebate those profits directly back to approximately 1 million ACA members. It's a highly calculated move, clearly meant to strengthen affordability and build goodwill, while Congress continues to debate longer-term solutions for the volatile ACA markets. They're also taking direct aim at what is arguably the biggest headache for doctors and patients alike, the bureaucratic nightmare of prior authorizations. You know, having to ask permission from an insurance company before getting care. Well, they're attacking this in stages. Step 1 is to eliminate 30% of all prior approval volume by the end of this year. Step 2 focuses on kids, eliminating nearly 2/3 of pediatric prior approvals. And Step 3 expands their Gold Card program, which entirely exempts high-performing providers from routine approval requirements, and that includes home health services. Furthermore, on the pharmacy side, Optum Rx is attempting to fundamentally rewrite the murky pharmacy benefit manager playbook. They're replacing the old-school model, which relied heavily on spread pricing, where middlemen pocket the difference between what a drug costs and what the plan pays, with a fully transparent, flat-fee-based system. And most notably, they've committed to passing 100% of manufacturer drug rebate discounts directly to their clients by January 2028. This is a massive, seismic shift in an industry that has faced intense scrutiny over drug pricing opacity. And finally, let's wrap up with Section 5, the full year 2026 outlook. Thanks to this stellar year-to-date performance and vastly improved operational efficiency, the company has confidently raised its full year 2026 adjusted net earnings guidance. Previously, they were targeting adjusted earnings per share greater than $17.75. Now, they bumped that up significantly to a projected range of $19.50 to $20 per share. But this isn't just about making more money. It's a clear signal to the market that their overarching strategy, mixing technological investments, sheer scale, and value-based care, is proving to be highly, highly lucrative. So we've seen the sheer gravity of their financials, over $1 billion a day in revenue. And we've seen their sweeping commitments to eliminate ACA profits, cut red tape, and completely rewrite the pharmacy rulebook. But the ultimate question you have to walk away with is this. Can corporate efficiency at a $112 billion scale actually succeed where traditional policy has failed? Or are we just putting a consumer-friendly Band-Aid on a fundamentally broken system? It's a multi-billion-dollar question, and it's one we're definitely going to be watching closely as these initiatives unfold. Thanks for joining me on this explainer, and I'll catch you next time.